Welcome to The Explainer. Today, we're going to tackle a simple but honestly a really powerful idea that completely changed finance. The Capital Asset Pricing Model, or CAPM for short. It's basically a formula that tries to answer a huge question. What's the right price for risk? Okay, so let's just dive right in with the big question CAPM is all about. As an investor, that if you want a higher return, you've got to take on more risk. That's a given. But how much more return should you demand for taking on a little bit more risk? How do you actually put a number on that trade-off? Now, this whole idea didn't just pop up out of thin air. It was really built on the shoulders of giants, specifically on the work of Harry Markowitz and his modern portfolio theory. So a few pioneers, William Sharpe being the most famous one, took that and ran with it. They took the next logical step and created this model, and yeah, it was such a big deal that it ended up winning a Nobel Prize.
All right, to get our heads around this, we're going to break it down into 5 parts. First, the core question. Then we'll look at the first map, the CML. After that, the true north, SML and beta. Then we'll see how it's used in practice, and finally, we'll see how the theory holds up in the real world.
So let's get into it. How do you price risk? Well, the first really big insight from CAPM is this. Not all risk is created equal. You've got to know what kind of risk you're looking at. The model basically says, okay, let's split all investment risk into 2 big buckets. In one bucket, you've got what's called unsystematic risk. Think of it as company-specific stuff, product recall, a CEO scandal, things that hit one company hard. The good news? You can pretty much get rid of this risk just by diversifying your portfolio. But then there's the other bucket, systematic risk. This is the big stuff that hits the entire market. Think recessions, global pandemics, interest rate changes, and this is the risk you just can't escape no matter how much you diversify. And this is the absolute game changer. The model asks a really simple but profound question. If you can eliminate that company-specific risk just by adding a few more stocks to your portfolio, basically for free, why on earth should the market reward you for taking it on? The answer? It shouldn't, and it doesn't. CAPM says you only get rewarded for taking on the risk you can't get rid of. That's systematic, market-wide risk. Okay, so once you accept that big idea, that only systematic risk pays, everything changes. It allowed economists to literally draw a new map for investors. And that map starts with a concept called the capital market line. So, before CAPM, we had Harry Markowitz's big idea, the efficient frontier. Picture a curved line on a graph. Every point on that curve represents the best possible portfolio you could build using only risky assets, like stocks. It's the maximum return you could get for a certain amount of risk. Anything below that curve? Not so great. Inefficient. But here's where it gets really cool. What happens when you add a totally risk-free asset to the mix? Something like a government bond. Suddenly, you don't have to stick to that old curve anymore. You can just draw a straight line from the risk-free rate touching the most optimal point on that curve. And this new straight line, the capital market line, or CML, is better. It offers a superior set of choices for every single investor. It's a whole new level. So what the CML really shows is the best possible return you can get for a given amount of total risk, which we measure with standard deviation. But, and this is a big but, it only works for these perfect, well-diversified portfolios. Still, it completely changed the game, becoming the new gold standard for how to think about building a portfolio. Okay, but there's a catch, right? The CML is great for these ideal, super diversified portfolios. But what about, a single stock like Apple, or your own personal portfolio that maybe isn't perfectly diversified? The CML doesn't help us there. For that, we need another tool, something more focused. And that tool is beta. This is it. This is the absolute core of CAPM. What's so special about beta? It ignores all that company-specific noise and measures only one thing: systematic risk. It tells you exactly how much a stock tends to move when the overall market moves. It's a measure of sensitivity. And it's actually pretty easy to understand. By definition, the overall market has a beta of exactly 1. So if a stock has a beta times greater than 1, say 1.5, we call it an aggressive stock. It's expected to be 50% more volatile than the market. If the market goes up 10%, it might go up 15%. And a beta of less than 1, like 0.5, that's a defensive stock. It's less volatile, moving only half as much as the market. So now, let's draw a new picture. Instead of plotting return against total risk, let's plot return against beta, our measure of systematic risk. What do we get? We get the security market line, or SML. And this line is basically the CAPM formula in a picture. It shows you the return you should expect from any asset, a single stock, a portfolio, whatever, based on the market risk it carries. It's our true north.
Okay, theory's great, but what's the point, right? So now let's get to the fun part. How does this actually work in the real world? How can you use this SML thing to figure out if a stock is a good buy?
So, imagine you're looking at a stock. You do your homework, you figure out its beta, and you make your own prediction about its future return. Now what? Well, the SML gives you the benchmark. It tells you, for that level of risk, here's the return the market should be giving you. And then you just compare your own forecast to what the SML says.
And here's the magic trick. If your stock plot's above that SML line, you might have found a bargain. It means it's expected to deliver a higher return than it should for its level of risk. We'd call that underpriced. And if it plots below the line, it's probably overpriced, not offering enough return for the risk you're taking. The whole game for an analyst is to find those dots floating above the line.
And believe me, this isn't just some textbook theory. Real-world fund managers live and breathe this stuff. If a manager is feeling aggressive, if they think the market's going to soar, they'll load up on high beta stocks to juice their returns. But if they're feeling defensive, worried about a crash, they'll pivot to low beta stocks to try and protect their capital. It's a fundamental strategy.
So you can see why CAPM is so influential. It's elegant, it's simple, it's a beautiful theory. But, and this is a big but, it's a model of a perfect world. And the real world? Well, it's messy. It's anything but perfect.
You see, to get that nice, clean, straight line, the model has to make some huge assumptions. It assumes a world with no taxes, no transaction costs, a world where every single investor has the exact same information and thinks about it in the exact same way. I mean, can you imagine? These things make the model work on paper, but they also create a pretty big disconnect from what actually happens in the market. And maybe the biggest knock against it, the most famous critique, comes from an economist named Richard Roll, and his point is brilliant. He says, look, the whole model depends on something called the market portfolio, which is supposed to include every single asset in the entire world. We're talking stocks, bonds, real estate, fine art, cryptocurrencies, everything. But how could you ever possibly measure that? You can't. And if you can't measure the market, Roll argued you can never ever truly test if CAPM actually works. It's a huge problem.
So where does that leave us? Well, the big takeaway is this. Even though we know the model isn't perfect, its core idea was absolutely revolutionary. It was the very first model that gave us a simple, intuitive way to think about the link between risk and return. It forced everyone to ask a critical question. What kind of risk am I really getting paid to take? Which really leaves us with a final question to think about. CAPM is a flawed map of the financial world, for sure. But is navigating with a flawed map better than having no map at all? Even with its imperfections, CAPM fundamentally changed the conversation around risk. It gives us a framework, a place to start asking the right questions. And sometimes just asking the right questions is half the battle. Thanks for joining this explainer.